They told you this couldn't happen again. They said the system was safer, smarter, fortified. And then, in just 36 hours, $7 trillion vanished. Not slowly, not quietly, gone. If you think this was just another market dip, you're missing the real story. Because this shock is whispering the same warning we heard right before 2008. What happened over those 36 hours didn't feel like a normal sell-off. It felt like gravity suddenly got heavier. Prices didn't drift lower, they snapped. Stocks that were considered untouchable leaders were hit alongside speculative names. Bonds didn't provide safety. Crypto didn't provide independence. Even traditional hedges behaved strangely. That's usually the first sign something is wrong beneath the surface, when diversification stops working and everything starts moving together. Markets don't do that unless fear replaces logic. $7 trillion erased isn't just a big number, it's larger than the entire annual output of most countries. It represents pensions, retirement accounts, sovereign wealth funds, insurance reserves, and institutional leverage all repricing at once. And the speed matters. In 2008, the collapse unfolded over months, with key moments spread out like warning flares. This time, the timeline compressed into hours. Algorithms, passive funds, and leverage turned concern into panic before most people even realized what was happening. The official explanation you'll hear is simple. Higher rates, sticky inflation, geopolitical uncertainty, pick your headline. But those are triggers, not causes. Triggers are what light the match. Causes are the gas already filling the room. The real issue is that the global financial system has been running on borrowed time and borrowed money. Years of cheap liquidity trained investors to assume the central bank would always step in. Risk was mispriced because consequences were postponed. Think about how portfolios were built over the last decade. Growth at any cost. Buybacks funded by cheap debt. Governments rolling over massive deficits at near zero rates. Asset prices floated higher not because productivity exploded, but because money was abundant and patience was optional. When rates finally rose, that entire structure didn't adjust gradually. It strained, then cracked. The shock wasn't that something broke. The shock was how many things broke at the same time. What makes this moment echo 2008 isn't the specific assets falling. It's the sudden loss of confidence in the plumbing of the system. Back then, it was mortgage-backed securities and counterparty risk. Today, it's duration risk, liquidity risk, and the quiet realization that balance sheets everywhere are far more fragile than advertised. When investors rush to the exits and discover the door is narrower than expected, prices gap down violently. Another uncomfortable similarity is the messaging. In 2007, officials said the problem was contained. In early 2008, they said the worst was behind us. Right now, the language sounds eerily familiar. Strong fundamentals, resilient consumers, isolated stress. But markets don't erase $7 trillion because everything is fine. They do it because expectations are being forcefully reset. And here's the part most people miss. This wasn't retail panic. This was institutional repositioning. Big funds reducing exposure, risk managers pulling limits, margin desks tightening terms. That kind of selling isn't emotional, it's mechanical. And once it starts, it feeds on itself. Falling prices force deleveraging, which causes more selling, which pushes prices lower again. That loop doesn't need bad news to continue. It only needs pressure. So the real question isn't whether this rivals 2008 in size or drama. The real question is what happens next, because moments like this don't appear out of nowhere, and they rarely end cleanly. They are warnings, not conclusions. Warnings that the assumptions we've been living with may no longer hold, and that the cost of ignoring risk has suddenly come due because markets don't unwind years of excess in a single move. They lurch, they pause, then they lurch again. After the initial shock, there's always a moment of false calm when prices bounce and commentators rush to declare a bottom. That's not relief, that's repositioning. It's the system taking a breath before deciding what it can no longer support. One of the most dangerous assumptions right now is that this was simply a valuation reset. As if stocks were a little expensive, bonds a little mispriced, and now everything is back to fair value. That story is comforting, but it ignores the scale of leverage embedded across markets. Corporate debt, government debt, household debt, derivatives exposure, all built on the expectation that rates would eventually fall and liquidity would remain accessible. When that expectation wobbles, assets don't just reprice, they reevaluate their own existence. Look at how quickly liquidity vanished during those 36 hours. Bid-ask spreads widened. Volatility spiked. Assets that normally trade smoothly started gapping between prices. That's not what healthy markets do. That's what stressed systems do when participants stop trusting each other's models. Liquidity is confidence made visible, and when confidence disappears, so does the ability to exit without damage. This is where the comparison to 2008 becomes uncomfortable. In 2008, the problem wasn't that houses fell in value. It was that nobody knew who was exposed, how much they were exposed, or who would fail next. Today, we face a different version of the same uncertainty. Who can survive higher for longer rates? Who needs refinancing soon? Who is quietly dependent on asset prices staying elevated? The answers aren't obvious, and markets hate uncertainty more than bad news. Central banks sit at the center of this tension. They spent years teaching markets to expect rescue. Now they're trapped by inflation, credibility, and political pressure. If they ease too soon, inflation risks returning. If they stay tight, financial stress spreads. In 2008, the response was fast, aggressive, and unambiguous. This time, the response is hesitant, conditional, and reactive. That hesitation alone is enough to keep markets on edge. Another key difference is speed. In today's market, information moves instantly, and so does capital. Algorithms don't wait for press conferences. Passive funds don't analyze fundamentals. They sell when thresholds are hit. That accelerates declines and compresses timelines. What once took months can now unfold in days. That's why $7 trillion disappeared before most people even adjusted their expectations. And yet, the most revealing signal isn't the size of the loss, it's the behavior afterward. Instead of confident dip buying, there's caution. Instead of bold forecasts, there's hedging language. Investors aren't asking how high prices can go. They're asking what breaks next. That mindset shift is critical because bull markets are driven by optimism, while systemic events are driven by fear of unknown connections. This doesn't mean collapse is guaranteed. It means stability is no longer free. It has to be earned through credible policy, transparent balance sheets, and time. And time is the one thing markets rarely grant when trust has been shaken. The shock we just witnessed may not be the crisis itself. It may be the opening chapter, the moment when complacency cracked and reality forced its way back into pricing, setting the stage for what comes after when the real consequences begin to surface. This is the phase most investors underestimate. Not the initial drop, not the headlines, but the slow realization that certain assumptions are no longer valid. That refinancing isn't automatic, that growth isn't guaranteed, that some balance sheets only worked in a zero-rate world that no longer exists. After shocks like this, stress doesn't announce itself loudly. It shows up quietly. A company delays an issuance. A bank tightens lending standards. A government auction clears at a higher yield than expected. None of these events alone cause panic. Together, they create friction. And friction is how financial systems overheat and fail. In 2008, Bear Stearns didn't fall the day housing peaked. It fell months later when funding dried up. Today's risks are similarly delayed, but no less real. Pay attention to where capital is going, not just where it's leaving. Cash levels rising, short-term instruments favored over long duration, defensive sectors quietly outperforming. These are not signs of confidence. They are signs of preparation. Big money doesn't wait for confirmation. It moves when probabilities shift. And probabilities shifted dramatically during those 36 hours. Another echo of 2008 is the public reaction gap. Most people didn't feel $7 trillion vanish. Their accounts updated, their apps refreshed, life went on. That's dangerous. In 2008, the real panic started only when market stress crossed into the real economy, jobs, credit, confidence. We are not there yet. But markets don't price the present, they price the path ahead. And right now, that path looks narrower. This is where perspective matters. Not every crisis looks the same. There may be no single Lehman moment, no dramatic overnight collapse. Instead, there may be a series of smaller fractures that slowly erode stability. Commercial real estate here, sovereign debt there, a shadow banking issue somewhere else. Individually manageable, collectively destabilizing. So why does this rival 2008? Not because history is repeating exactly, but because human behavior is. Excess built during easy times, confidence stretched too far, risk dismissed as outdated. Then a sudden reminder that markets are systems, not machines. They depend on trust, liquidity, and belief. Once those weaken, numbers move faster than narratives. For viewers trying to make sense of this, the takeaway isn't fear, it's awareness. Moments like this separate speculation from strategy. They reward patience, liquidity, and humility. They punish overconfidence and blind faith in models built for a different environment. The goal isn't to predict every move, it's to understand the regime you're in. $7 trillion erased in 36 hours wasn't an accident. It was a message, a warning that the era of effortless gains and guaranteed backstops is fading. Just like in 2008, the early signals arrived quietly for those willing to listen. The question now isn't whether this shock mattered. It's whether we choose to learn from it before the next one forces the lesson. In the end, financial history doesn't punish ignorance, it punishes denial. And the investors who survive moments like this aren't the ones who panic or chase rebounds. They're the ones who recognize that when the market speaks this loudly, it's not noise, it's a shift. And ignoring shifts is how small shocks turn into defining crises.